right, so this bull market run, is it Donald Trump's? Is it Barack Obama's? What if I told you it's both? We're going to explore that, but we're also going to explore a third entity here, in fact, who probably was more of a major player than you know or appreciate and brought us to this point. The guy who orchestrated near 0% interest rates for upwards of a decade. I'm talking about Ben Bernanke, the Federal Reserve Chairman, in the midst of this meltdown, who just kept providing the liquidity and cash banks needed to right themselves. That was then. What does a big-time banker think of it now? Former BB&T CEO John Allison. You know, John, in no small measure, I don't know whether we could have advanced the way we did for good or bad reasons if not for Ben Bernanke and not for interest rates being forcibly dropped to zero. What do you think?
I think lowering rates definitely created an incentive in the economy. How much incentive is an interesting question, because how much rates were actually forced below what market rates would have been. Absolutely. Since we were so underutilizing resources.
Pushing what was obvious. But what did you think of that? I mean,
right.
You know, there's the view of fiscal stimulus that was provided by Barack Obama, a lot of tax cuts and the rest that were provided down the road by Donald Trump, but in the middle of that, a zero rate environment. What do you think?
I think it actually helped incent economic activity. But I do think it also leads to miscalculations, and the Fed does have to undo what it did, and that could be a challenge. Although I'm generally optimistic about where the economy goes, I think one of the big negative drags will be the Fed trying to raise interest rates back to normal levels, which, if it doesn't, will lead to excess optimism and misinvestments like we had in 2005 and 2006. So they have an interesting challenge in that regard.
Yeah, to put it mildly. You know, John, I've been asking a lot of smart folks over the last couple of days, could it happen again? Could we have another financial meltdown? Could we have the kind of stuff from which we were rising 3,453 days ago? What do you think?
I think it's unlikely, but I still think it's possible. I think that, the Fed has stimulated housing again, particularly with a lot of these programs where you don't have to put anything down to buy a house. You can look at the stock market, where I feel pretty good about it, but it's pretty high relative to economic standards, and it pretty much depends on everything continuing to go well. Now, I think there are a lot of positives. The tax cut, reduced regulation. I think even the court system now, we have more of a sense of rule of law, and all that creates optimism among businesses, and that's incredibly important. We got huge advances in technology. On the other hand, I think if we start an international trade war, or if we don't deal more effectively with immigration, we're going to drive up labor costs, which can really hurt businesses. We need more people in the United States if we're going to continue this growth. Human beings that are productive raise the standard of living. So if the government did nothing, except do its very normal activity, I would be pretty optimistic. But whether they'll do something dumb, it's hard for me to guess.
Now, we're told that banks in particular, are shielded from something that could hit them again, akin to the meltdown, that they have to have more cash on hand, be a little bit more prepared for that. But I always have felt, I don't know how you feel, John, that in the midst of a meltdown or stocks just losing their value so fast, that's your currency right there. And if that's imploding, you're imploding. But what do you think?
Yeah, banks largely reflect the economy, and banks are fairly leveraged. And unfortunately, a lot of the things they've done to theoretically reduce risk, I think, have increased risk, because their whole weighting of risk, this whole issue of how they compute bank soundness, has encouraged banks all to take the same risk. And that's a lot of what happened in the last crisis. Banks were way overinvested in housing because the incentives that the government was providing to overinvest in housing. So I worry that a lot of the things that they thought would improve the system actually increase the risk in the system. I'm a big advocate of getting the government out, except require banks to have strong capital positions, and then you'd get diversified risk among the institutions, and you reduce one company could fail, one bank could fail, but the risk of a systematic failure would actually be reduced.
What do you tell young people? We talk about, 55% of Americans are invested directly or indirectly in the stock market. That means close to half are not, particularly young people. What do you tell them who hear you now talking about these markets and the economy, and they say, I want in. I want in at these levels?
I tell people to do diversified investing. If you have a little bit of savings, you want to put some of it into the stock market, you want to put some of it into the bond market, and and make some level of real estate investments. I think you should only do it if you can afford to do it for the long term. But I think you can force discipline on yourself. When I went to work for BB&T, it was a little tiny farm bank, and the president of the bank said, John, I'm not going to pay you much, but I'm going to teach you how to live on what you make. And I think there is, and I started buying BB&T stock.
Wow.
Right after I went to work for the bank, and that was very significant in terms of my own personal financial position.
And look at you now, young man. All right, John, a real pleasure. Thank you very, very much. John Allison, the former BB&T CEO, former Cato Institute CEO and president as well.